Hi, today we're here with our good friend Ron Dickinson from Dickinson Investment Advisors. Ron is with us today to talk to us about why he recommends to his clients that they put real estate into their investment portfolios.
Our job is to get each client from where they are now into a retirement journey of their dreams. And more importantly, to keep them retired well. This is irreplaceable wealth that needs to be managed profitably and maintained throughout the retirement. So our clients, we want them to have a comfortable retirement and one where they can pass the wealth on to their children or the charities of their choice. So it's a job that we take very, very seriously. So let's talk about how we manage these portfolios. Traditionally, investors will use either stocks or bonds. And traditionally, it's thought that 60% stocks, 40% bonds, that was a typical retiree's portfolio, and that would service them well in retirement. Well, I'm here to tell you the world's changed, and it's changed a lot. So the 60-40 portfolio is basically dead, or at least it should be. Stocks are simply riskier than they used to be, and bonds just don't pay enough. Inflation is increasing, and it can literally eat a 60-40 portfolio alive over time. Now, unfortunately, most 401ks or work plans, that's all you have available is stocks or bonds. I remember going to seminars and everybody was telling me on the benefits of real estate, the cash flow, tax benefits, appreciation and value, and it was like the perfect investment. And then I would ask the speaker, well, how much do people put in there? And it would go anywhere from 7 to 12%. And I kept thinking to myself, if it's so great, if it's a panacea to the volatility of stocks and higher cash flow of bonds, why aren't you more assertive than that? And so when I retire, I don't think I can put 40% in bonds, and it's like watch a paint dry sometimes. And right now, bonds are actually dangerous. They can go down in value. So I'm just not a bond guy. I'll use them for clients when they need it. But I said, I think I'll go 60% stocks, 40% bonds, which was pretty assertive versus what a lot of people do. So for me personally, we go up to 40%, and I have a handful of clients do it. Probably in our medium risk models for retirees, we're taking that 60-40 model and make it 60% stocks, 20% bonds, 20% real estate.
Got it.
So the bonds give us a little liquidity when we need it, but the real estate's really putting the power in the portfolio, and it also reduces the risk of the portfolio from what you might think at 100% down to half of what other people have, which is comforting.
Got it.
So the new thinking is to bring a concept called alternative investments in, which simply means not traditional stocks or bonds. It's another thing. So in this category, we have private equity, private credit, commodities, and private real estate. Now, I use the word private. What I mean is that these are investments that are not priced by the stock market. It's not priced by the crazy emotions of the market every day. Investments are based on independent appraisals, and prices are a lot more stable. Now, we'll use all of those approaches I already mentioned, and to a varying degree, depending on your risk tolerance, to build a stable portfolio. But we greatly prefer private real estate. That's real estate is priced by appraisals. And these prices come from cash flows, and from rents. So if a bomb goes off in North Korea, a high-tech company comes out with bad earnings, or inflation kicks in, the stock market might crash in an instant, and in the short term that can feel very unstable. But the price of a building full of tenants rarely even budges in price. It's simply a lot safer from a price point of view, and it just keeps turning out cash. Now, a few other reasons we like real estate is that you can leverage your investment. So for every dollar that I put in, the bank's going to loan me 3 more. So I really have $4 working, and that's a very, very powerful concept. Secondly, the tax benefits can be tremendous. You can literally put cash in your pocket today and not have any taxes due until you sell the investment. So between the leverage and the tax savings, you can parlay your wealth quicker into another project, all in a manner to grow your nest egg even faster. So we feel this is better diversified and safer than traditional portfolio styles. And we've just been thankful that we could use Metonic as part of the piece to build into our portfolios to add the stability and high cash flow.